Welcome to today's WealthChannel webinar. I'm Jimmy Atkinson, co-founder of WealthChannel, and today's webinar is Generating Greater Income with Less Risk. Today's webinar is sponsored by ASYMmetric ETFs, and our presenter today is Darren Schuringa, founder and CEO at ASYMmetric ETFs. And with that, Darren, welcome. Thanks for joining us today. How are you doing?
Jimmy, it's great to be here. Wonderful. Despite what's going on in the overall equity markets.
Yeah, it has been somewhat tumultuous over the past, 12 months or so. But we'll dive into that and discuss that in more detail here throughout the course of our hour today. Darren, before we tee up your presentation, before you start sharing your screen and run through your deck, I had a couple questions I wanted to ask you about income investing. Firstly, to start us off, really simple question. Why is income investing so popular? We hear from a lot of our audience of high net worth and ultra high net worth investors and their advisors that there's just a huge focus from that audience on building a high yielding, high income portfolio. Why is it so popular these days, Darren?
Well, Jimmy, there's a number of different reasons. One is that there's an aging of the population. So as people move into retirement and your productive asset is no longer your job, your most productive asset now, or only productive asset is your portfolio. So it needs to generate current income for investors. And so that's one. Investors are needing and in need of current income. And number two is life expectancy is increasing. So it's great to have current income or high current income, even better if it's quality and principal safe. But the problem then is inflation, and we're facing that right now. So high current income's purchasing power is eroded by inflation. So you also need a portfolio that produces current income or high current income, but also has the potential to appreciate over time so that your purchasing power of your overall assets or your productive asset increases with time and is not eroded by inflation. And then finally, we've been faced with an environment in really the West, but almost globally, where interest rates have come down, and interest rates coming down has penalized savers. And I mean, if you look at the trend since the late 1970s in the United States through pretty much current, the trend has been downward. Recently, we've been in a little bit of an upward trend in interest rates. So where do savers go to get income? It used to be treasuries offered a decent yield and current income, but that is today it's okay. But generally speaking, that wasn't the case, especially when interest rates got to zero. So the need for income is acute. You need current income to live off of as you move into retirement, and then you need current income that produces or has the potential or prospect of generating principal appreciation over time, again, to outpace inflation.
Yeah, you mentioned that the long-term downward trend of interest rates, it was much higher in the 70s and 80s, and it's been kind of a long, steady downward trend since then. We have recently seen quite a big uptick in interest rates over the last 12 months. One of ASYMmetric's ETFs, which I think you're going to get to in your presentation in a few minutes, is MORE, ticker symbol MORE. It seeks to generate more than double the income of the S&P 500 with less risk. That's the tagline on some of your marketing literature and on your website. The S&P 500 is currently yielding well below 2%. And because of that recent uptick in interest rates, treasuries are now yielding anywhere from 3.5% to nearly 5%, depending on the duration you're looking at. You can get 12 to 60 month CDs that are yielding in the 4s, touching the 5s a little bit in some places. Those types of instruments are more than doubling the S&P 500 with less risk. So why not just buy treasuries and CDs for current income?
Well, I think right now may be an interesting time to be purchasing some fixed income. Interest rates are back up. You're actually getting paid to take on a little bit of risk, and there's no question. So I think all of the fixed income instruments that you just mentioned, CDs, treasuries, whatever you're looking at, are paying decent yields right now. And so that's great. They answer one of the questions. They're giving you current income. but they're not answering the second part of the equation, which is long-term, the potential for principal appreciation, right? The nature of fixed income, a bond's $1,000 today. You hope you get your $1,000 back when it matures, and you get paid interest rate. You receive dividends or interest, sorry, coupon as long as you own the bond. So there's no appreciation over that period of time. So where we are in the United States is interest rates maybe look decent, given what's going on right now with a little bit of the financial crisis in banks. Something did break based on the Fed raising interest rates now. Silicon Valley Bank, and we're seeing some contagion effects moving into other banks, and regional banks under pressure. Now Credit Suisse is under pressure. So the Fed's even in a more difficult position. Do we stop tightening? Well, inflation really hasn't come under control. So your real rate of return on your bond is not that great when you look at it relative to inflation from an investor standpoint again. So your purchasing power of that 4.5% is still being eroded by inflation, but the Fed's hands are a little bit handcuffed. So if they keep tightening, it's probably going to drive us into a recession, more so, deeper, more problems than we have right now. So I look at it, probably the Fed pauses. I don't know. This, I'm pontificating. My crystal ball, I've known for years, is really opaque. But it is that means fixed income is probably decent right now at current yield levels. And so as an investment, but long term, it doesn't answer the question. If interest rates go back down, you have maturity of 2, 3, 4, 5 years, whatever it may be. What are you going to do in 2, 3, 4, 5 years? Especially if we get into this Japan type cycle of low interest rates, bit of stagflation, maybe a bit of inflation. But generally speaking, the trend has been lower for interest rates. It's forcing investors, and it has for years, to take on more risk to try to find that income. So what Moore is designed to do is find that balance. It's like you need current income. You need growth in income because of life expectancy. You need growth in income because of inflation. And Moore looks at it and says, okay, not all income is created equally. And so how do we find good income? And how do we define good income? Good income is number one, principal appreciation. It has a low probability of losing money, and even better, price appreciation. Has the potential of generating positive returns in terms of appreciating over time. So that's what we're looking at and trying to help investors with the exact problem that they're facing, and that's what Moore is designed to do. Art.
So I get the sense that the philosophy of your family of exchange traded funds, asymmetric ETFs, is combining principal protection with high current income. Am I right about that? And why is that strategy or philosophy important to you and your investors?
I don't know about everyone else on this webinar, but my lessons have been learned, and they've generally been costly to learn. So they've been investing, they've been money losing. And so I've spent most of my career as an institutional investor in investing in income producing asset classes. And I've learned one thing, that high current income is only one aspect of the investment equation. If you're going to lose 50% of your principal in an investment, it takes too long to earn it back in income. And generally, once the principal price goes down of that investment, generally distributions get cut. So you no longer even are getting the same income as before. You're getting reduced income. So it's doubly bad. You've lost principal, you've lost income. So you want to avoid that type of income trap, and which is similar to a value trap, but from an income perspective. So looking at that, my philosophy as an institutional hedge fund manager is, in most institutions agree with this. I think virtually all do. And again, high net worth individuals and family offices, is that principal appreciation is the most important aspect of investing. And I mean, look, Warren Buffett even said it, right? What's the number one rule of investing? Don't lose money. What's rule number 2? Look at rule number 1. And what's rule number 3? Look at rule number 2, right? That's how important preservation of capital is. And why? From my philosophy, it's really simple. It's like, if you don't lose money, and it's not that you lose 50%, you need to make 100%. Absolutely. But even more importantly than that is that by not losing money, we are, as investors, leaning into the most powerful tool that we have, which is compounding rates of return. And now, borrowing again from someone who's infinitely smarter than I am, Albert Einstein, he said that's the 8th wonder of the world, compounding rates of return. If you lean into it, if you don't lose money, it's not only that it's hard to make it back up, but it's like you don't lose money. You don't need the same volatility of returns to generate more wealth over an investment horizon. So let's give it 10, 20-year period. You're going to get to the same place or ahead with less risk. It's like it's the holy grail of investing. So that's why capital preservation is core to our philosophy. It's what the technology I developed. All of our strategies are quantitatively driven. So there's no human element. It's a disciplined, repeatable process. I've also learned another lesson that I can become my own worst enemy, right? Fear and greed. I'm a human being, and it affects me too. And maybe even stubbornness you could throw in there, right? I start to think I'm right about something and I disregard what the market's telling me. And you can do that at your own peril. So our technology, again, quantitatively driven, rules-based, removes the human element, removes human emotion, has one primary investment goal when it was created, and that was to provide protection against bear market losses, which can be catastrophic. And so, Jimmy, if you do that, then my question to the team was, if we do that, what does it look like? What does the return look like? Don't worry about returns. Just can we accomplish preserving capital? Now, if we can do that and don't generate any returns, it's not very helpful because you can be in cash. But if we can do that and still manage to capture the majority of the upside of the market, wow, we have something that's really interesting and a unique way for investors to gain equity exposure, to gain income exposure. And again, and I think this is where you see in our marketing literature and where our ticker symbol MORE, M-O-R-E, fits in. It's more what investors are looking for: more income, more equity upside, more wealth appreciation with less risk. And so that's the holy grail of investing. So if what we're doing and our technology produces that, investors should be flocking into asymmetric ETFs.
Well, I'm looking forward to learning more about that, Darren. So with that, I'll let you start sharing your screen and begin your presentation, generating greater income with less risk. And again, for those of you who may have just joined us in the last few minutes, or in case you missed my earlier announcement, we are going to save some time at the end for some live Q&A. And we may even sprinkle in one or two questions during Darren's presentation. If you have any questions for Darren, please use the Q&A tool in your Zoom toolbar to submit those questions. Darren, I see your screen. It looks great. Please go ahead.
Okay, thanks. So Jimmy, a little bit of what we spoke about here, and I'm going to make this presentation to you as much as to everyone else, just to keep it personal, is looking at these topics. And this is our philosophy. What we know, retail investors have been told in order to achieve desired equity returns, they need to accept equity volatility. And so and what does that mean? You look at the S&P 500, it's the potential to lose 50% more of their assets during a bear market. And the S&P 500 since 2000, what have the returns been? 6.2% over the last 23 years, and with 50% downside. That's a terrible risk return payoff. So the question, and going back to our philosophy, do we wish there was a better way to invest? We do. And we know institutional investors, and that's our next slide, have been looking for that and have found it. Is what we've seen and what we see here is institutional high net worth investors are focused on capital preservation. And a capital preservation approach to investing, as I said earlier, leans into the power of compounding rates of return. Right? Portfolios that do not sustain big losses can potentially achieve the same returns, wealth appreciation, wealth accumulation over time with less risk. So we think there is a smarter way to invest, and we would argue and put forth today in this webcast that asymmetric ETFs provides that smarter way of investing. And so what do we do at asymmetric ETFs? Asymmetric smart solutions are founded on the philosophy of capital preservation. And we believe that a capital preservation approach is a smarter way to invest because it offers the potential for greater wealth creation with less risk. And I don't want to back off. If our technology only developed and produced downside protection, lower risk protection against bear market losses, it wouldn't be good enough, because there are alternatives that can mirror that. You can get that type of protection and even better by being in cash. So smart solutions seek to lower the risk, but not the returns. And returns, we're talking about long-term capital appreciation in a portfolio. So diving deeper into our smart solutions here, and I'm going I'm going to break out more for a second because we have three different categories: smart equity, smart alpha, and smart income. And the investment goals of each: smart equity are equity returns with a fraction of the risk. Smart alpha, better returns than the market with similar risk. And smart income, more income with less risk. And so the question that hopefully comes to mind is, well, why are they smart? And why are they smart is for the reasons we just mentioned, because all of these are superior ways of investing. Equity returns with a fraction of the risk, that certainly is smart. Better returns with a similar risk profile, that's smart. You're getting more with a similar risk profile. And finally, more income with less risk too, is the holy grail of investing. So what to expect, more of what you're looking for. And you see that we really do play on more a lot outside of our ticker for our recent ETF, but more in just the philosophy of what asymmetric stands for. So why would you invest in these? When you look at smart equity, smart alpha, and smart income, now these are, again, quantitatively driven strategies. What we're looking at here are the index returns that the ETFs follow. They go back to 2000 through 2022. And why would you invest in each of them? And these are the main reasons. Well, for smart equity, you can get 9.2% market return. So that's our goal there. Is it achieving its goals? Certainly. It's generating market returns, that 7 to 9% equity return. We'll talk about the risk in a second. Smart alpha, better returns. I mean, 14.5% annualized. If you look at that, and one of the things that sticks with me for my CFA is the rule of 72. 72 divided by your return gives you how fast your money or your investment will double. What, 14.5%? You're doubling your money every 5 years. And that's smart. If you're getting market returns that are significantly greater than the market, more than 2x the market, with a similar risk profile, that makes a lot of sense. And then finally, smart income is more income. Historically, it's had an average yield of 4.8%. I've been in this business now for a fair bit of time, and I remember when we were budgeting initially for making financial plans, we'd have 5% for our fixed income because we could get that from treasuries. And then we'd look for 10% out of our fixed income. Those numbers have changed. Both have come down. Your equity returns have come down, and your fixed income returns have come down. So smart income is still generating those type of historical income and returns. So when you look at it, more of what you want here on the smart equity just compares itself to the S&P 500, 9.2% versus 6.2%, smart alpha 14.5% versus 6.2%, more than double the returns of the market. And smart income, it's giving you 4.8% versus 1.9% S&P 500 yields. And moving forward, less of what you don't want, right? Which is risk. And when we look at risk, it's whether it's an institutional investor, or whether it's a retail investor or high net worth investor, you're going to lose or get fired as an investment professional because you lose someone a lot of money, right? Risk, standard deviation, Sorrentino ratio, Sharpe ratios, they're all interesting. But at the end of the day, if you lose someone a lot of money, you're going to get fired. Because people can lose money on their own, and so they don't need to hire a professional to lose money for them. So what we look at and the way we quantify risk is what's the absolute worst case scenario within each strategy on a historical basis. And I also suggest, whether you're looking at asymmetric in our suite of ETFs, or you're looking at another manager, you really want to understand the risk profile of something. Say, what's your worst scenario? What was the maximum loss that I would have achieved or experienced invested in whatever strategy that you're telling me? And that's what we're looking at here. So smart equity, these are all based on month-end numbers. The worst decline from 2000 through 2022 is 10%. So remember, we said the risk return profile for the S&P 500 is pretty terrible. Your maximum drawdown is over 50% losses. And in fact, 50% losses approximately were achieved both in the dot-com bust 2000 through 2002, and again in the Great Recession of 07 through 09. You lose 50% of your money, and your average returns are 6.2% versus 9.2% average returns, annualized returns, with a 10% downside. A much better balanced risk and return, a much better risk and return profile as a result. So smart alpha risk profile, we say it's in line with the market. We like to manage expectations, under promise, over deliver. It's had a 39% drawdown. versus a 50% drawdown on the S&P 500. But again, you're getting over 2x the return of the index. So far, and on all three of our strategies, you have a return profile that's less than the S&P, return profile that's greater than the S&P 500, or an income profile greater than the S&P 500 with a risk profile that's significantly less. From least risky, 1/5 of the drawdown, to half the drawdown, to essentially about 80% of the drawdown, but in all cases less maximum drawdown relative to the S&P 500 with superior return profiles. And why does it matter? This is why it matters, because it's the power of compounding rates of return. So if you look at it, the S&P 500, $1 million invested in the S&P 500 in 2000 would have grown to about 5 million, right? So $1 million to 5 million. Well, if you put that into your smart equity, again, you would have generated almost not quite double the returns of the market, but pretty close. Your smart income, and this is where Jimmy earlier questioned, it's not just high current income, but it's a prospect for growth, has even delivered better returns than that. So your $1 million is growing to over right around $13 million. And then incredibly, your smart alpha, even after this recent pullback here that it's experienced in the market, is still up to over 22 million. So 1 million has grown to 22 million versus 5 million. And that, so for us, smart alpha is a new source of alpha within a portfolio. It's an interesting way of getting more consistent alpha over the market and generating more, again, of what investors are looking for, which is alpha when we're in a bull market. So those are our three solutions today. Most of our time is going to be spent on more looking at our smart income solution. Our disclosure, these are all benchmarks. You cannot invest in benchmarks. They are all followed by our ETFs that we'll talk about at the end here as I wrap up. So digging deeper into our smart technology, this is our smart technology, which is called ASYMmetric risk management technology, powers all of our ETFs. So the beauty is the technology is rules-based. It's a disciplined, repeatable process. There's no human element in it. So that removes the random nature of me or other individuals getting involved in making calls which may or may not be right, that are based on emotion, versus a quantitatively driven solution. So it unites all of our products. So if you understand what you're getting in smart equity, it's going to roll over into smart income. It's going to roll over into smart alpha. So, and if it works in one, which it has worked in the technology, I developed it a little over a decade ago. It powered one of the largest hedge fund seeds in the country in 2015. That was an investment made by an organization called PAMCO, which is a fund of hedge funds, which is merged with KKR. They're now the $25 billion fund of hedge funds, one of the largest in the world. Spent a year analyzing our smart technology. And at the end of it, said, Darren, we love it. It makes sense. It produces market returns with a fraction of the risk, and it's an elegant solution. So we've brought this technology. It hasn't changed since I developed it. It's highly scalable. I took it from its initial application and asked an analyst, can we integrate it into the S&P 500? And will it produce, again, does it provide protection on the downside against catastrophic losses, which can occur in bear markets? And is it able to capture the majority of the upside, putting those two together to produce, market returns with a fraction of the risk? So what we found is yeah, it worked and into triple Qs. And then so that was our smart equity category. And then we introduced it into smart income, into smart alpha. So let me talk about what the technology does. I'm keeping it high level and simple. And I see Jimmy came on, so you want me to
yeah, Stuart, or Darren, we get a question from Stuart. I just wanted to interrupt you and see if we can get this question answered. Stuart asks, are those returns back tested? You just said it was developed 10 years ago, but the data is 20 plus years ago.
Yeah. So Stuart, great question. All of our returns, and it's not a play on word, because they're forward tested. And what does that mean? If you back test something, no one's ever seen a back test that looks bad, because what you do is you keep tweaking the rules until you get return streams that you like, and then you present those return streams to the market. What we've done is very different. I developed this technology again over a decade ago. It is the same technology I'm going to present today. And we applied the technology without changing anything, the same way we manage it in whether it's a hedge fund solution, whether it's in our initial ETF, ASPY, or our two new ETFs, MORE and ZSPY. It's run the same way. So we just applied this technology to new data sets, one being the S&P 500, and we looked at what the returns were. So when we're looking at it, that's called forward testing. The technology is already developed, you're just applying it to a new data set. And so that's where the returns are coming from. So it's not back testing. Back testing is when you keep tweaking your model until the returns look good. And this way, the model didn't change. All we did is applied it to a new data set. So Jimmy, did that answer the question?
I believe it did. But Stuart, if you have a follow-up question, or if anybody has any other questions, please keep them coming, and we'll keep getting them over to Darren. Thanks, yeah. Darren. You can continue.
No, Jimmy, and that's a good question too, because really the first part of the slides are saying, what am I to expect from the technology? And let me even take one step back to Stuart, to your question. When PAMCO made the investment, which was a $250 million hedge fund seed, at that point, it was truly just back tested data. It was when the strategy was developed, there was no live money in a hedge fund, and they came in and looked at it and said, no, this makes sense. The rules make sense. The way you're measuring market risk makes sense to us. We see that why it's worked in the past, and now it's working currently. It should work going forward too, based on the rules and the way you're looking at market risk. So let me touch on how we do that then. So smart solutions are all powered by our smart technology. It's quantitatively driven, rules-based strategies. Again, repeatable, disciplined, repeatable process, no human element, powered by our asymmetric risk management technology. At the core, what our smart technology does is as market risk increases, portfolio risk decreases. And this seems simplistic, but it's very much of an institutional way of managing risk. And if you ask Goldman Sachs on their prop trading desk, what they do is they see market risk rising, they see market volatility increasing. What does the head trader say to the prop traders? Pulling your horns, lower your gross exposure, lower your net exposure. And it's really a common sense approach. Why does she say that? Is because it's the ability to, you're mitigating risk. What's the maximum you can lose is what you have invested in the market. So by pulling in your horns, lowering your gross exposure, lowering your net exposure, you can still lose 100% of what you have invested. Therefore, in highly volatile markets, don't have a lot of exposure to the market. And so that's what Goldman Sachs is doing. That's what our institutional solution is doing here. So I want to keep it simple. As market risk rises, portfolio risk decreases. So what does our technology do? How does it measure market risk? So it does three things. Asymmetric risk management technology measures, monitors, and manages market risk. Okay. Now the first part of measuring market risk, we measure market risk into three buckets: bear market, uncertain market, and a bull market. So it's pretty easy. We put terms to it: risk on, risk elevated, and risk off. Risk off is a bear market. Market risk has increased. You want to lower overall portfolio exposure. An uncertain market, we're getting, there's a lot of uncertainty, conflicting signals of which direction the market's headed. Is it in a bull market or a bear market? And at that point, we want to be on the sideline and preserving capital, waiting till we're highly confident we're there, moving into or in a bear market or in a bull market. Then a bull market is when our signals are agreeing with each other. So we measure market risk and classify it into three different segments: bear market, bull market, or an uncertain market. Risk on, risk elevated, risk off. And so how do we do that? And this was my John Bogle moment. And John Bogle did a study on active managers, and he said, most active managers don't outperform the S&P 500. As a result, 80% was the number. So if 80% don't outperform the S&P 500, 80% of investors would be better off just owning the S&P 500. And he's right. And paying the least amount for investment management services, and passive investing was born. My John Bogle moment was I spent a lot of life and money on trying to look at big data quantitatively and develop algorithms that were able to get and give asymmetric an edge on predicting where the market was going to go. And at the end, my belief firmly is that it's impossible to predict where the market's going to go. And why? Because black swan events exist, which are events you cannot plan for because you're unaware of them. And whether it's in life or whether it's in an algorithm, it doesn't matter. If you're unaware of something, you can't plan for it or you can't program for it. And number two is that correlations change over short periods of time. And as a result, even if you are aware of something and the relationship changes, what you're programming for doesn't work. So the John Bogle moment was then don't try to predict where the market is, but now with a high degree of confidence, let the market tell you where it is currently. So that's what we do. The asymmetric risk management technology lets the market tell us where it is currently, and it uses two price-based signals. So price, that's the market, right? One is the price movement of the market, so a technical analysis, and two is the price movement of the underlying securities of the market, and that's realized volatility, which is a proprietary measure of volatility that we created that measures actual volatility versus implied volatility. And if you think of the common sense again, and hopefully that's what comes out of this presentation, that this makes sense, asymmetric risk management technology, hence why PAMCO made the investment and why you should as well, I would argue, at least at a minimum, take a deeper dive and speak to me personally, is because these two price-based signals are telling us where the market is currently. And again, going back to my earlier comment, I'm not fighting the market, right? Why? I make, as an investor, I make money in the market. So if the market's trending upward, why do I want to see a bear market around the corner if it's moving up? No, we want to participate in an upward moving market, a bull market. And if the market's moving down, trending down in bear market, in a bear market, we want to offer protection in a bear market and also the prospect, depending on the strategy, of generating positive returns in a bear market. So by letting the market tell us with a high degree of confidence what the current market risk environment is, we're actually playing into our strong suit again, which is the market. That's where we make money. And not trying to be contrarian and making guesses or best estimates on where the market's going to be and maybe being right or maybe being wrong. So with a high degree of accuracy, asymmetric risk management technology, by using two price-based signals, is able to predict where the current market risk environment is. So if you look at our bear market, our price momentum indicator, again, this is the price movement of the markets. We're looking at the overall market, a technical analysis. It's driven by the 200-day moving average. So if the market's above the 200-day moving average, right here, it's a walk sign. The market's trending up. That's a positive. We generally see that in a bull market. If the market is broken beneath the 200-day moving average, that's a don't walk or a risk off. The market's trending down. That's reason for caution. Nothing good happens below, or potentially nothing good happens below the 200-day moving average. The market's broken a major technical support, and then finally, or flipping over. So those are the price momentum indicators. The price volatility indicator is a measure of dispersion. It's looking at the price movement of the underlying securities that comprise whatever market we're managing risk. And so let's say use the S&P 500 as an example, because it's two of our products are based on the S&P 500, ASPY and ZSPY. It's looking at the 503 securities currently that comprise the S&P 500. It's measuring the dispersion. So the one thing about price vol, which is our proprietary measure of realized volatility, it's never wrong. And that's a bold statement, but follow me for a second, because it's measuring the actual movements of the underlying securities. So it's just a quantitatively driven or statistical measurement of risk. So it's not predicting risk, but it's saying where the current risk is. So what you find is that the dispersion of returns when the market's in a bull market here and realized volatility is low, the dispersion of returns are tight, like water in a solid, so like ice. The molecules are tight together, and stocks are generally moving up together technically. as risk starts to increase, water goes from a solid into a liquid, the dispersion of returns start to move apart. And finally, as you move into a bear market and you get panic selling, and anyone who's a little older, who's lived through a couple of bear markets knows what that looks like. It's indiscriminate selling, and your dispersion of returns blows apart like water moving into a steam. And it's really descriptive of what happens with fear and greed in the market. And so the two things come together, right? We don't just look at a technical analysis. We also want the technical, is the market trending up or down, corroborated by what are investors telling us? What does investor sentiment look like as measured by realized volatility? Are investors panicking? And so if in a bull market reading, the market's trending up above the 200-day moving average and realized volatility is low. In an uncertain market, the market's broken down. Okay, that's bad. So our technology says, that we don't like that. Now, what is realized volatility telling us? Is it high or low? And if realized volatility is still low, we have two signals that are conflicting. So we're going to sit on the sideline. We need both of our signals to agree before we're going to commit a portfolio directionally, whether it's either up or down. And then finally, in the bear market, we have the market broken down beneath the 200-day moving average technically, and we have a spike in realized volatility. This blowing apart of dispersion of the underlying constituents of, in this case, the S&P 500, this example, and we see panic selling. When both those things come together, we're highly confident we're in a bear market currently. Whether in a bear market tomorrow will be to be determined, but currently we're in a bear market. And if you look at it, bear markets last what? And anywhere from 12 to 18 months. The longest was 4 years, 1928 through 32, 3 years, 2000 through 2002, a couple of years, 07 through 09. So our signals, that the benefit of looking at price is high degree of accuracy of where the market is currently. The downside of price is they're never going to tell you where you're going to be. They're always rear view looking, right? Price, once a price is printed, it's history. You're looking in the rear view mirror. So with what to expect from asymmetric risk management technology is you'd hope that it would capture the majority of the upside. And I can show you the results of ASPI, our initial fund that captured 81% of the upside of the S&P 500 through the bull market of 2021. And it cut losses in less than half in the bear market of 2022. So, but the market's gonna roll over before the signals. So you're never gonna capture, you're never gonna top tick or bottom, pick the bottom out with asymmetric. But that's okay. You don't need to. Again, these are long-term investment solutions that we're trying to capitalize on, positioning a portfolio to participate or protect, and ultimately to profit in either kind of market by getting the market right. So that's how we monitor risk, and then we manage it. And I touched on this already. When in a bear market, it's the least amount of market exposure, because what can you lose? Going back to the Goldman Sachs example, only what you have invested, and you can lose 100% of it. So don't have a lot invested. So we reduce our overall gross exposure and to the market, what's at capital at risk. And two, depending on the strategy, we actually potentially go or do go slightly net short, so that your money always has the prospect of earning a positive return versus whether we're in a bull or a bear market. And in fact, if the technology is accurate in identifying whether we're in a bull or bear market. And then the greatest exposure is in a bull market. We're positioned to profit. We want to participate in the majority of the upside of a bull market because we're in assets that are appreciating. That's when we want the income, when we're getting high current income and we're getting appreciation. That's the holy grail, what we're looking for and more. So smart technology for smart income. This is getting into more here in more detail, is asymmetric risk management technology for more allocates capital to high income producing asset classes in a bull market and away from those that are in a bear market. So the high income producing asset classes are MLPs, REITs, and utilities. Well, I shot forward a screen. And so ultimately what our technology is doing, again, it accurately measures current market risk at its core. That's what asymmetric risk management technology does. So now we're applying it to MLPs, REITs, and utilities. And so the first question the technology is asking is, okay, are MLPs in a bull market? Based on and then the question is yes or no. And then are REITs in a bull market? Yes or no. Are utilities in a bull market? Yes or no. And if all three are in a bull market, the technology will allocate a third of the portfolio. If one of them drops into a bear market, then we'll allocate 50-50 to the asset classes that are still in a bull market. And if another one drops off, so you only have one in a bull market, then 100% of the portfolio will be allocated to whatever asset class is in a bull market. The logic there of the technology, again, allocating away from asset classes where principal is at risk, have moved into a bear market towards asset classes where the prospect of price appreciation is high, or in a bull market. So you're getting high income, but you're also getting high quality income because that's the prospect of capital appreciation. So that's what asymmetric risk management technology is doing in more. Now, it's smart technology, correct? This is a high income producing strategy. So if all three MLPs, REITs, and utilities are in a bear market, what does it do? It doesn't go into cash. It says, okay, in a risk elevated environment, the fund seeks to protect capital while still maximizing income by allocating to U.S. Treasuries. So are any treasuries in a bull market? And then so it looks at 30-year, 10-year, and 90-day T-bills. And then says, are any of these in a bull market? If so, we want to maximize income for our investors too, but without putting principal at risk, or doing our best to protect principal. And so the risk elevated it'll move into the safety of treasuries if treasuries are in a bull market. And then finally, security. At the end of the day, capital preservation. If there's no bull markets anywhere, and last year is an example where equities were down and fixed income was down, then the technology will allocate to the ultimate or relative safety of cash from a principal protection standpoint. So that's what more is doing in terms of allocating capital, measuring risk across MLPs, REITs, utilities. If they're in a bull market, great, it will allocate to them. If they're not, then it says, okay, can we find a bull market story in U.S. Treasuries? Great. If we can, we'll allocate to the Treasury that gives us the maximum amount of income. If we can't there either, then we have to go to the ultimate safety of cash, because we'd rather be sitting on the sidelines waiting to have high degree of confidence we're entering into a new bull market phase in these asset classes. And at that point, we're really getting in at the bottom. We're picking up high current income with asset classes that are poised to really appreciate over time, and we preserved the principal along the way. So that's what more is doing. I'll answer more questions. So when you look at, again, this is a report card on the efficacy of the technology. So here you're looking at the risk environments where you see the gray lines, you are in a risk on environment, and the white is risk off. So you see here, again, 07 through 09, MLPs depreciated significantly here. That was almost a 50% decline. The technology had us in a risk-off environment. Again, here, risk-off environment. Again, here, risk-off environment. So certainly, and you see that the same for REITs. And two things to notice: pretty much the entirety of the downturn here in these various asset classes, when you see big correction, this is utilities, that we're in a risk-off environment. We're not getting whipsawed on, off. That's not helpful. Our portfolios are rebalanced on a monthly basis. They're looking to capture and participate in the entirety of a bull market and provide protection or profit in the entirety of a bear market. So if you look at the efficacy, clearly asymmetric risk management technology is highly effective at identifying bear markets and without getting whipsawed back and forth in between bear markets. So it does provide the protection. It does measure market risk accurately. And as a result, again, there's no human element, reduces exposure and provides protection. So what you see here, again, is it produces better returns with less risk. And so more as a fund relative to MLPs, REITs, and utilities, more we're looking at the index performance, which again is integrating our technology into and measuring the risk on MLPs, REITs, and utilities. And then when they're in a risk-off environment, lowering exposure, risk on, adding exposure to them systematically. You can see that the orange line is more and more at the end of this period of time produces the best performance. But But more importantly, it's look at the risk profile. It's not just the performance, but here's the swings you have in MLPs, which at one point were the best performing. But look at the losses that you would have taken at this point. You know, more than 50% of your capital would have been lost, which is catastrophic over a multi-year period of time, and then bouncing strongly off the bottom. No one can live with that volatility, especially in a fixed income producing asset class. More just gives you a slower, steadier ride to greater returns and higher income. Here's your REITs. So ultimately, whether you invested in REITs, utilities, or MLPs, and you've used those for current income, please take a look at more. It's giving you better returns with more secure income over the period of the past 23 years that we're looking at. So that's just an example of comparing more to the asset classes that comprise it and making it up. So better performance with a significantly lower risk profile. So digging deeper into smart income, it's engineered to generate 2 times the income of the S&P 500 with less risk. We use the S&P 500. It could be other asset classes. I saw a question come through earlier on that. And it's like, the reason we use the S&P 500 is because most investors understand it, especially retail investors. It's easy. So if you're looking at the S&P 500 as a benchmark, which we do with all of our strategies, the risk profile in all of our strategies is below the S&P 500. So our most risky strategy, our Smart Alpha, has a risk profile that's less than the S&P 500. So we're doing it just because it's ease of understanding for investors. You can compare it to any benchmarks if you want to call me and look at other benchmarks. We have a lot of studies prepared that we'd be happy to share with you, but we compare it to the S&P 500 just for ease of comparing all of our strategies relative to one benchmark. The annual yield, as you can see here, and more, it's variable, but it's consistently right around the 5% mark. In certain years, when it dips below it, it's because we've moved into a risk elevated environment in some of our asset classes, or into risk off for a period of time, because there's no bull markets. And when that happens, income is going to go down a bit, always above the S&P 500, even in our worst years. But from an income perspective, you're looking for higher and consistent income. So that 4 to 5% is pretty much most years where you're finding it. You've seen some peaks in the early 2000 through 2002 where it reached 7% in the portfolio, but it's giving you an indication, again, consistency of income, certainly more than the S&P 500 consistently since its beginning, and less volatile. Annualized performance here that you're looking at, it's had a couple of down years, significantly less than the S&P 500, fewer down years than the S&P 500. The upside capture on more has been in line or better in most years than the S&P 500. So you're getting a significantly more income relative to the S&P 500, significantly less risk, which is important to us. And then you're even on an annual basis, you're pretty much capturing what the market's doing in most cases, or a little better. So that's the risk profile. And then it's the power of compounding rates of return. Why does all this matter? Why does capital preservation matter? Why does safety of income matter? Because you're getting more of what you're looking for. At the end of the day, you can get more wealth accumulation with less risk by focusing on capital preservation and leaning into the eighth wonder of the world, which is compounding rates of return. So you'll look at it here. This is a risk return profile. There's one thing I do want to point out: correlation 0.39. If you're interested in a lot of you, I'm sure, will, our asset allocation more will lower the risk of an overall well-diversified portfolio while increasing the income and the performance due to its low correlation. And then the goal and the investor profile, it's looking for a conservative investor that's looking for secure income that is maximizing income and minimizing risk. So risk profile is low overall for the fund. All of our funds have a risk profile that's below the S&P 500. So I'm going to turn it back over to Jimmy here and go to questions on more or any of our other strategies. So Jimmy, back to you.
Yeah, great. Well, thank you, Darren. And we did have quite a few questions that came in. We've got another 8 or 9 minutes before we wrap up and call it an hour and call it a day. So in our remaining time here, let's get to some of the questions. We had quite a few people ask us if you were able to share a copy of the deck. I know you shared it with me. Would you like me to distribute the deck to our audience, or do you want me to direct them to you, Darren? How do you want to handle that?
No, please share the deck.
Okay, so
we're big on transparency, and even look at our website. We want investors to understand what's going on within our portfolio. So every month you'll see what the current allocation looks like across all of our strategies. So you know what to expect, or if you're investing on behalf of your clients will know what to expect.
Okay, so I'll get a copy of the deck to everyone who registered for the event shortly here. Okay. We had a follow-up question from Stuart. He was the one who had the question about backtesting a few minutes ago. He asks, he points out that what you did is called out-of-sample testing, but you must have some in-sample data testing as the foundation of your hypothesis. Often, data managers use a 70-30 split between the two data sets. So I'm gathering is that your returns are back-tested and not actual traded dollars. Is that right?
That is correct.
Okay.
That's correct.
Good. Couple questions now from Jennifer came in a few minutes ago. She asks, her first question is, what guardrails do you have around keeping balanced allocation, i.e. end up over allocated in short-term treasuries?
So Jennifer, if I, how do we prevent from being over allocated to short-term treasuries? Let me answer how it would take us to get allocated, or how more would get allocated to short-term treasuries. More would only be allocated to short-term treasuries when asymmetric risk management technology has not identified a bull market and either MLPs reach utility. So our high income producing asset classes are all in bear markets, which generally would occur during a major market correction. So, okay, we can't find any safety in our high income producing asset classes. Then it will switch. The technology will say, well, we still want to generate high income. Can we find a bull market in treasuries? So then it looks at 30-year, 10-year, and 90-day T-bills. And it looks for a bull market in U.S. treasuries. And it will allocate to, if there's a bull market in U.S. treasuries, it will allocate to 100% of the portfolio to whatever treasury is in a bull market and offers the highest yield. Again, the goal of maximizing income while still providing the potential for portfolio or principal protection. And then finally, if it can't find any bull markets in treasuries, nothing in high income producing equities, nothing in treasuries, so risk off, then it's going to go into to ultimately cash for a period of time until it starts to identify bull markets again in treasuries or securities. So when you look at the portfolio historically, it's not allocated to treasuries. A very small percentage of the overall time it's allocated to treasuries, to short-term treasuries, even a shorter allocation over the past 23 years when you look at the index data. So I hope that answers your question. Those are the guardrails. The only time we'd be there is if, again, it's risk off in all the high income producing asset classes. And then the only U.S. treasury we can find a bull market would be short-term treasuries.
Well, she just asked a follow-up question, which is there any point in time in which you could potentially be all 100% allocated to short-term treasuries?
Yes, there would be, correct? Because the way the technology works is that when it looks at treasuries, it's going to say, okay, let's just say they're all in a bull market. Long dated treasuries and short dated treasuries are all in a bull market. Then what it's going to do, it's going to allocate to whatever treasury offers the highest amount of yield that's in a bull market. So absolutely, by the very nature, we're going to be 100%. The portfolio will be 100% invested in treasuries if there's no bull market in again, high income producing equities or these asset classes, and there are bull markets in treasuries, it will be 100% allocated to whichever treasuries in a bull market that offers the highest yield for a period of time. And that's our risk elevated posture until we start to see where we really want to be, which is where we get price appreciation and higher current income, which is in these high income producing asset classes. So it's a holding pattern when we're into treasuries. It's not a permanent allocation within the portfolio. And hopefully that helps think about that. Would be a risk elevated event or posture within the portfolio.
Yeah, no, that's great. Thanks for answering that, and thanks, Jennifer, for the questions. Actually, Jennifer had one more question.
Sure.
She submitted a few minutes ago, which was, what is your cash balance currently?
Okay, so Jennifer, currently it's pretty close to zero, and as long as we can find the asymmetric risk management technology, can find a bull market either in the high income producing asset classes, which is really where we want to be invested because they're in a bull market and we're getting high current income and price appreciation, two things that investors need and that more is looking to produce. Or we're going to be in treasuries because we can find a bull market there. We're going to be 100% invested. The only time we're going to be in cash in the portfolio is really in catastrophic times. There's no bull market in equity, so we're probably into a pretty severe bear market where correlations have spiked across all asset classes. So no bear markets, no bull markets in high producing asset classes. On the fixed income side, interest rates must still be rising because there's no bull markets in treasuries either. So there's not this negative correlation between equities and treasuries. And at that point, we're going to be 100% invested in cash for a period of time, so we can either find a bull market in treasuries to increase the yield or in high income producing the asset classes, MLPs, REITs, or utilities. So again, let me summarize that. The portfolio more will be fully invested always, and the only time we'll be in cash is if there's no bull markets in equities or in treasuries.
Got it. Okay. And then Jennifer, thanks for all those great questions. Darren Stewart had another question for you. He says, so are you just using the 200-day simple moving average to determine if REITs, MLPs, and utilities are in favor or out of favor? And if so, are you using a particular index for each asset class?
Yes. So the answer to that is yes and yes. So for more, we're using the 200-day simple moving average to determine whether the MLPs, REITs, and utilities are in favor or out of favor in currently. So we're using the price momentum indicator, one of our two indicators from asymmetric risk management technology, to determine whether they are in or out of favor. And yes, we are using specific indexes on each of MLPs, REITs, and utilities to determine whether it's above the price momentum indicator or the 200-day moving average or below the 200-day moving average.
Good. We are just about out of time. I've got one more question here for you, and I'm also trying to get that link to the deck shared. So before we hop off, but
right.
A question I have for you now, Darren, regarding some of these income asset classes that you've been referring to, REITs, MLPs, utilities, are the publicly traded versions of these valued at a discount compared to private funds right now, broadly speaking?
I'm not sure. So I don't have that data in front of me, and I don't want to answer a question that I don't know. And I think the only place you'd have that would be in REITs. Pretty much, right? So it wouldn't apply to utilities or MLPs. So I don't have that data in front of me. So I never want to answer a question when I'm not certain. I could find out, but I'm not sure. Yeah, and so there's my answer to that question.
Okay, well, I kind of caught you off guard with that one,
yeah.
But that's all right. It was a tricky one. We stumped you once. Otherwise, you did great, Darren. Thank you so much for your presentation today. I did just post a link to the deck in the chat. If anybody wants to grab that version right now, that's the PowerPoint version. You should be able to open it up on your device, though. And we are at the top of the hour, so we're going to cut everybody loose here. This entire webinar was recorded. We're going to circulate the recording to everyone who registered for the webinar, and we'll make sure to link to the deck in that in the page that recording will be hosted on. Darren, I don't know if you had any final thoughts or final words. Otherwise, we'll let everybody go.
No, just thank you. Thank you for attending. Thank you for your interest. If you'd like to follow up with me and have a call, my number is 212-755-1970. Would love to connect in person.
Perfect. All right. Well, thank you everybody for attending and participating. Thanks for all the great questions. And thank you to ASYMmetric ETFs, our sponsor for today's webinar. And thank you to Darren. I'll see you guys next time. Thank you so much.
Thanks, Jimmy.